This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everybody, welcome back to the Human Action Podcast. I am going solo again this week, doing an elaboration on my suggestion for how the Fed could be eliminated. All right, so recently I was in a zero hedge debate, and then the last episode here with the Human Action Podcast, I recorded it the day that the debate was going to occur ahead of time, sort of as a dry run of my talking points that I condensed for the debate. But largely, even though I had planned on talking about the specific proposal of like, well, what would you replace the Fed with, or what would you do about dollars and that sort of thing, even in the last week's episode of the Human Action Podcast, I didn't have time to spell that out because I spent so much time on the front end just making the case for why any rational, good-hearted person should want to get rid of the Fed. So I thought that's such a critical component. Why don't I go ahead and spell it out here? And I should stress the function of this is mostly pedagogical, right? It's not that I am saying, here is Bob Murphy's plan for what they should go do starting next Tuesday. It's largely just to explain, to teach how all these things fit together so you understand how the world works right now. But also, it's like a trump card people play on social media, I saw, where they say, oh yeah, everyone's got the slogan, end the Fed, but they actually haven't given any serious thought to what do we do the day after we end the Fed, huh? And so global markets would crash, and that just shows how sophomoric you are. Sit back, kids, while the adults in the room talk about reforming the central bank instead of just, let's get rid of it, right? So because of critics like that, I thought, why don't I go through and just show this is a realistic, plausible way that you could unwind the Fed. Okay, so number one, why don't I explain what my rationale was strategically in the debate, or what my goal was strategically. As people probably know who are familiar with my work, as a good Austro-libertarian, I don't want the U.S. government or any government around the world having anything to do with money or banking. All right, so my first best outcome and policy recommendation, if you want to call it that, would be to say all government interference in the fields of money production and banking regulation and blah, blah, blah should cease. Okay, let everything be voluntary in the private sector, and that would be the best way forward. However, that alarms people, and since the zero hedge debate was focused on getting rid of the central bank, I thought, let me just narrowly focus on that resolution. And so I crafted my position, and this plan that I'm going to go through with you folks here in the Human Action Podcast was just saying, how could we get rid of the central bank but still leave the production of U.S. dollars that are official currency and the money that is, good for the satisfaction of debts denominated in U.S. dollars, still reserve that function for the U.S. federal government somehow. All right, so that's what my task was. And incidentally, in case you think I'm being a sellout or something, I appreciated that's what Ron Paul does in his book on End the Fed. I think he does it. I'm virtually certain he does it in the first chapter. It might even be like the first or second page. I could be wrong about that. It's been a while since I've seen the book, but he does it early on where he stresses and says, hey, when we start talking about ending the Fed, a lot of people think that means Americans have to go back to using gold coins or something, and that you're going to be, pulling out a chunk of metal and slapping it on the counter and haggling with the shopkeeper. And he's saying, no, U.S. dollars, official U.S. dollars issued by the government existed as of 1912, right? Because remember, the Federal Reserve Act was formally signed in late 1913, and the Fed was up and running in 1914. All right, so in 1912, if you walked around and asked Americans, hey, what money do you use? They would say dollars. We've always been using dollars since the formation of this country. What are you talking about? Okay. And if you say, what, but there's no Federal Reserve, there's no central bank, how can there be dollars? They would say, well, the government issues them, right? Okay. So in this episode, I am not going to go through the history. It's really interesting. Let me just say, I make this point repeatedly. Some of you are probably sick of hearing it, and the reason I do this is because I used to be misinformed. I used to think that the US dollar was always green pieces of paper with pictures of presidents on them. It raises the question, well, whose picture was on, the bills before those presidents were even presidents? But in any event, I always thought US dollars, official ones, were green pieces of paper with the numbers and the dollar sign, but that they used to be backed up by gold. And that statement is true for a period in U.S. history, but actually the further back you go, at some point, this is from the founding of the country up until the eve of the Civil War in particular, the U.S. dollar, the official U.S. dollar that was valid for the satisfaction of legal debts and things like that, were gold and silver coins. Okay? So to say like, oh, what's an official $10? It's a coin, a $10 gold eagle. That's 10 US dollars. And that was the money officially that the government would produce. Okay. And if you wanted like a dollar, it would be a coin, a $1 silver coin. Or there would be a $quarter, which was 25 cents. Or just call it a quarter for short. Okay. And they're silver. All right. So that was the official money. There were no paper notes that were official legal tender US dollars issued before the Civil War in U.S. history. All right. To be clear, private banks could issue banknotes, right? And so you might have a wad of paper in a billfold or something that you could go and buy stuff with, and people would accept it at par. And in normal commerce and so forth, interactions in normal times, the pieces of paper that had stamped on it, whatever, 10 US dollars, that might be able to buy you the same amount of stuff as an actual gold coin that was stamped 10 US dollars. But in a panic, that wouldn't be the case. People would revert to wanting the real money, which were the gold and silver coins. Okay. And again, another way of seeing it is those banknotes that, the paper pieces of paper that banks issued didn't have legal tender laws backing them up. Right. So if you owed somebody, you had a contract with someone and you owed them $50 and you tried to pay them with notes issued by some bank and the person said, no, I don't want that. You got to give me actual money. You couldn't just force the guy to take the notes. That, a judge or somebody would say, no, that's not legal tender. In many cases, the person would accept the notes, in which case it was fine, but they would have the legal right to say, no, this contract says you owe me 50 US dollars. What you're trying to hand me are banknotes. That's not money officially, right? I can insist on. Whereas if you try to, give the person $5, $10 gold eagle coins and they say, no, I don't want that. You could say, well, legally you have to accept this. Okay. So I'm just explaining that. So when we say originally the US dollar was backed up by gold or silver, that actually can be confusing to people. And again, when I was younger, I misunderstood that originally the US dollar was defined as a specific weight of gold and or silver. Okay. And then eventually silver was demonetized. You may have heard of the crime of 73. That was in 1873 when they stopped what was called the free coinage of silver. Okay. And from that point forward, it was just gold. The dollar was defined as a certain weight of gold. Okay. All right. One little tidbit: during the Civil War, the U.S. government, the Union, did issue pieces of paper that were ostensibly legal money, interchangeable with gold and silver coins. But of course, people reverted to just paying with the paper and hoarding the gold and silver coins. And those were called greenbacks for obvious reasons. All right. And then there was inflation in prices because of, printing all that money. And so then those, from that point forward, technically, if you had some of those, that would be legal money also. Okay, so that's when things started getting complicated. All this stuff I spell out in my book, Understanding Money Mechanics, that the Mises Institute puts out. We'll put a link here in the show notes page, but if you can't wait, you can just go Google Robert Murphy, Understanding Money Mechanics PDF. It'll pull up for you where I go through all this stuff. Okay, so there's all that going on in the background. Point being, originally, coming back to it, as of, let's say, 1912, Americans had all grown up in a world in which their money was the U.S. dollar. There were the first Bank of the United States and the second Bank of the United States were described as predecessors of the Federal Reserve. That's how the history books would describe them. But everybody agrees, both fans and foes of central banking, everybody agrees that the first Bank of the United States and the second Bank of the United States were not really central banks the way that like the Bank of England or the Banque de France were central banks, or the Bundesbank in Germany. Okay, so the U.S. model did not copy the methods of central banking that old Europe had inaugurated and adopted. Okay, and then even the Federal Reserve itself, why is it called the Federal Reserve? Because originally it was 12 district banks that were largely autonomous. So you couldn't even speak of what's the Fed's discount rate in the beginning. It wasn't until the 1935 consolidation under the Roosevelt administration and the depths of the Great Depression that they consolidated all the Fed's power in Washington and New York. And you could begin speaking of what's the Fed's policy on such and such. Okay. So strategically, Ron Paul, I think, does that early on in his book on Ending the Fed, is to show people this isn't as radical as you think. Again, it's not that we're in favor of the U.S. government having a monopoly on the production of U.S. dollars in terms of legal tender base money, if you're familiar with that terminology. It's just that to get people warmed up to the idea of what is a fairly radical move, you don't want to overwhelm them. All right, so if I'm talking about, hey, could we privatize the roads? And I'm in a debate about resolved, all roads should be privatized and owned by members of the private sector, not the government. I'm not going to get into private police and military defense in that debate, right? And if my opponent in it tried to suck me into that, I would just strategically say, that's a separate issue. We're talking about roads right now. I mean, I wouldn't lie or something, but I'm just saying we can talk about privatizing roads and still keep government police and the military, because that's going to complicate things, right? We don't want to lump the two together, right? So likewise here, that's why strategically I'm focusing on getting rid of the Federal Reserve while the U.S. government is still in charge of dollar production. Okay, so what does that mean? Let me just show you a couple charts here just to give you a sense of how these things interact with each other. So the first one is various monetary aggregates. So the green line is what's called the monetary base. The blue line is what's called M1, and the red line is M2. The monetary base is reserves that commercial banks hold with the Federal Reserve itself. So it's like a checking account balance that regular banks hold with the Fed. And it's also actual currency, like $100 bills, Benjamin Franklin's, that sort of thing. M1 is very money-like things held by the public. So green pieces of paper, right? Because you can, in your wallet, have $100 bills, $10 bills, and so forth. So that's part of M1. And also checking account balances that the public holds with regular commercial banks. And then M2 is broader. It includes things like savings account balances, or what could be called time deposits, as opposed to demand deposits, if you're familiar with that terminology. Okay, so M2 includes everything M1 does, plus some other things as well that are still very money-like, but not exactly money. Okay, so that's the reason for these different gradations. Okay, just to give you an example, so you understand the distinction. If you have 10 $100 bills, right, 10 Benjamin Franklins in your wallet, you say, how much money do you have? You say, oh, $100. Okay. However, that's legally and economically distinct. If someone's, you pull someone over and you put your bank card in the ATM and you pull up and you say check balance and it says you have $1,000 on deposit with Citibank in your checking account. Someone might say, how much money do you have? You say, oh, I got $1,000. See right there. So in both cases, you say I have $1,000, but what you mean by that is actually different. Or what economists mean by that. Maybe what you mean by that's the same thing, but I'm saying when economists define these things and they talk about like how much money is in the economy, that sort of thing, how many dollars are there and so forth, there's different definitions and things you can include in the aggregate, right? And so on this particular example, the reason there's a distinction is technically there could be a run on Citibank, right? If everybody tries to go to Citibank and take out their hey, I got $1,000. If everyone tries to withdraw it thinking, yeah, I can just go in or go to the ATM and there's limits and daily limits or whatever, but in principle, if I hit it a few days in a row, I can get 10 Benjamin Franklins out. That's the $1,000. And then my checking account balance would show zero, but I would be holding 10 $100 bills, right? Either way, it's $1,000. And any individual can do that. Of course, if too many people try to do that, it won't work because Citibank does not have literal cash backing up everybody's checking account balances, right? It's what's called fractional reserves. And so that's why M1 is higher than the amount of currency in circulation, for sure, right? So that's why there's this distinction. And also, too, that those, the fact that Citibank owes you $1,000, right, that you're a liability on the books of Citibank, that is not as economically significant as you holding 10 $100 bills. In particular, if you owe somebody money, you owe someone $1,000 and you hand them over 10 Benjamin Franklins, they have to take it, right? They can't refuse that in terms of the U.S. justice system, the courts. But if you write them a check on your Citibank account, and especially if it's a situation where Citibank is possibly going bankrupt, then the merchant could say, or the person could say, no, I don't need to accept a check written on your Citibank checking account. Okay. So that's just some of the reason for these distinctions. So anyway, looking back at this diagram, you can see that there's much more M1 and M2 than there is of what's called the monetary base. One little thing, and partly why I went through this is just I want to explain this little quirk because I've seen this going around social media over the years. In 2020, you can see M1 zooms up. And people were saying, oh, look at how much money they printed during COVID. And that's a bit misleading. They did print a bunch of money during COVID, but the reason that blue line shot up so much is they made a regulatory change. It's not worth getting into the specifics here, but it blurred the distinction between checking account balances and savings accounts, or what would be called demand deposits and time deposits. So they relaxed the restrictions in 2020. It was the same time they got rid of reserve requirements too. If you don't know about that right now when we say legally speaking, how much do banks have to hold in cash or deposits with the Fed backing up checking accounts? The answer is 0%, whereas it used to be around 10%. Okay, so they got rid of that in 2020 also. But anyway, because of that relaxation of the regulation, the distinction between checking account balances and savings account balances was blurred, And M1 is a narrower definition of money. And so effectively what happened was savings account balances were not included in M1 in the year 2019. In the second half of 2020, then going forward, everybody's savings account balances were in both M2 and M1. And that was new. The latter part was new. And so that's why M1 jumps up. So a better indication, if you're looking at charts like this, of how much did they pump in during COVID is you can see that zoom upward in the red line, which is M2, right? Because M2 was not affected by that definitional change, right? Because savings account balances had always been in M2. And so that jump up in M2 is truly due to, that's apples to apples. Okay. So my point in going through with this, besides just mentioning that quirk so you can avoid making a foolish mistake on social media, is when we talk about, okay, well, how do we put the U.S. monetary system on a firmer foundation if we don't like the current system? It's like, okay, yeah, we're going to get rid of the Fed, and then we're going to have the federal government kind of be back in charge of just producing dollars. You can say, well, what dollars do you mean? What level, what monetary aggregate in terms of the total number of dollars that exists right now is a snapshot in time? Which one do you mean? All right. So for various reasons, in this proposal I'm laying out, I am going to focus on the monetary base, because to me, that's something that the government really does have strict direct control over. As far as commercial banks then pyramiding on top of that. So what happens is, like, you put $1,000 in actual currency, like 10 Benjamin Franklins into your checking account balance, and they might lend out whatever, 950 of it to somebody else. So there's a sense there in which the bank, by making that loan, just created 950 extra dollars, right? The other person thinks they have that 950, like in their checking account. Let's say you still think you've got your 1,000 in the checking account. And so the original 1,000 of the paper currency got turned into 1,950, right? So for that element, what I'm proposing here is to say, if we got rid of the Fed, which is a lender of last resort, kind of encourages banks to be more aggressive and risky with their lending practices, because they know if they get caught with their pants down, you've got the Fed waiting in the wings to rescue them. So if we get rid of the Fed and the Treasury makes it clear that we're not rescuing banks, if they get caught, they're going down, then I think that would make banks more prudent in their lending practices. And the big one is if they got rid of FDIC. Okay. So that's, sort of tangential to this argument here, but I am just saying, if people are listening to my policy recommendations, I would say that would be the path to go down, that you take away the subsidies and privileges given to the regular private commercial banks. And I think in practice, their reserve ratios would be a lot higher than they are right now. And so that would shrink the gap between things like the monetary base and M1 and M2, right? The banks would not take the base money and then create huge multiples on top of that in loans, because they would need to keep higher reserves, I claim, right? All right. Let me show one more chart here while I'm going through stuff in terms of the graphics, and then we'll just revert to the logical arguments. So here, just to give you an idea, this is what's happened with the Fed's balance sheet going into the original global financial crisis in 2008, 2009, and then what happened, with COVID. So you can see, so that the top of this is showing the Fed's assets, and then the bottom is showing its corresponding liabilities. All right. And so you can see that in terms of the asset side, the Fed did with the various rounds of QE and then the COVID response load up on treasuries. That's the light blue section. But the dark blue is showing agency debt and mortgage-backed securities. All right, so agency debt meaning like Fannie and Freddie bonds. Okay, so that's all housing-related stuff, assets, right? And so you can see that didn't exist on the Fed's balance sheet before the financial crisis hit. All right, so that's relatively new. Okay, there's all sorts of other stuff going on with like reverse repurchase agreements and so forth. I'm not going to get in all that stuff here. But what I am trying to get across is right now the Fed is sitting on many trillions of dollars worth of treasuries and mortgage-backed securities. Now, here's the idea. We want to get rid of the Fed, but still have the U.S. government be in charge of the quantity of U.S. dollars. And again, what I'm suggesting is the U.S. government is just going to be directly in charge of what's called base money, right? Like so right now the Federal Reserve issues Federal Reserve notes, right? If you look at your paper money in your wallet, it's a Federal Reserve note. So historically, like the way this worked was just like the private banks as of 1810 could issue bank notes that would have their names on it, right? So that's the thing. This clearly was not official money because bank notes issued by a particular bank would look one way and bank notes issued by a different bank would look a different way, even if they both had printed on them, $5 US or something. Okay? It's just like if you had a gift certificate to Best Buy and a gift certificate to Walmart back before they had plastic cards, like back in the day in the 80s or something, for those of you who are that old, right? If you had, it was a piece of paper and it just said, oh yeah, I can go to Walmart and buy $50 worth of stuff, or I can go to Best Buy and buy $50 worth of stuff. I don't know when Best Buy started. Maybe it was in the 80s. You get the idea. Okay, but they're clearly not interchangeable, and they're not the same thing as having a $50 bill. Okay, so that's what banknotes were. Technically, it was saying the bearer of this note can go to any of our branches and turn it in and get gold or silver coin of that, face amount. And so to the extent that people in the community trusted that pledge and that, oh yeah, if you anytime you wanted, you could just go to a branch of this bank, turn this piece of paper in, and they'll give you the gold or silver coins upon demand. Well, then those notes would circulate interchangeably with the gold and silver. But that's only when people thought that pledge would be honored. If there was a financial crisis or a panic, as they used to call them, then that might not be the case. And then there could be a run on the bank and people try to turn the notes in, or just even if that didn't happen, just in general, people might say, no. Or there could be a premium, right? Somebody could say, yeah, this thing costs $10 if you pay me in coin, but it costs $12 if you're going to pay me in banknotes. Right? It could be things like that. Okay, so what we now think of as official currency as Americans are actually Federal Reserve notes. If you look at the fine print, all right, and that's because again, it's coming out of the framework of earlier money and banking in U.S. history. It just made sense when they established the Federal Reserve. It was a bank. And so, a bank issues bank notes. And it's a liability on the Fed's books, right? Just like for a commercial bank, if you have $1,000 in your checking account, that's a liability on their balance sheet. And if they issued notes, then that's a liability on their balance sheet. Okay? So what I'm saying is, if we're going to get rid of the Fed, but that's what we're narrowly trying to do, is just get rid of the central bank per se without messing with the U.S. government's prerogative in issuing official base money, U.S. dollars, then have that revert to the Treasury. And I would say right now, any actual, Federal Reserve notes or any reserve balances that the regular private sector banks right now have with the Fed, because that's legally equivalent, right? If Citibank has $1 million on deposit with the Fed in its account with them, they can say, you know what, we got to replenish our ATMs. We're going to draw down $800,000 of that. Send us $800,000 in currency, and the authorities will print that up and send it to them, and they'll debit the electronic balance that Citibank thinks it has with the Fed and send them the cash. Just like you can go into Citibank and say, hey, electronically, the ATM is saying I have $1,000 on deposit with you. I want $800 because I'm going to go, take my family into the city or something. And so I want to load up on cash. And they will give you $800 in green pieces of paper, and then your account electronically will go from 1,000 to 200. Okay, so that's what the commercial banks do vis-a-vis the Fed, except the Fed, when its customers want to, quote, withdraw their cash, the Fed doesn't open up this big vault that's got green pieces of paper backing up everything. No, they just have it printed. Okay, so I'm saying you could transfer those liabilities directly to the Treasury. I mean, it could be some subsidiary of it or something like that if you want to keep the stuff legally distinct. But I'm saying that responsibility could be taken from the Fed and transferred over to the Treasury, as well as the Fed's assets could be transferred over in the beginning. And then the Fed would lose all of its special legal prerogatives. So this was an issue that, like, David Beckworth brought up in the zero hedge debate, is he said, Bob, there's a lot of stuff the Fed does right now. It's like the centerpiece of the global financial system, at least in terms of the Western countries, using the SWIFT system and blah, blah, blah. They got currency swaps. We got reverse repos. We got all this stuff going on, daily transactions occurring. It's not just a matter of, the Fed's going to engage in open market operations to try to boost employment or something. Like, no, the Fed is doing a lot. It's like right in the middle of the financial plumbing for planet Earth. And so if we just got rid of it, that would be very disruptive. And I said, okay, that's fine. So we can just take away its privileges. Right? So the analogy I used in the debate was when the Soviet Union fell, there were plenty of state-owned enterprises. Right? There were a lot of factories, there were bustling farms and so forth that technically the Soviet government owned in terms of the property rights such as they were in their legal system over there. And then when you reverted more to a market economy, what do you do with all this stuff? And you could say, well, geez, we got all these factories making cars and tools and things like that, and all these farms producing food. It would be pretty disruptive if that all just disappeared, right? We're not just going to abandon all this stuff. And right, but let's figure out a way to get that into the private sector. And there were different ways that they went about that, and some disastrous and some not so disastrous. But the point was, yes, if something is actually providing a legitimate market function, just because it was originally owned by the government doesn't mean the people going to work there and everything need to stop. It could just be that ownership could get transferred into private hands through some mechanism. And then if it really does pass the market test, well, then it can stay in business. If it doesn't, then it'll go out of business. Those assets won't be destroyed. They could just be sold off to the highest bidder, the way that normal bankruptcy proceedings happen under capitalism. So if an enterprise isn't working, it ceases, and then its resources get transferred to other profitable enterprises where they can be used more effectively to serve, what the consumers want. Okay? So likewise here, if the New York Fed is doing all kinds of stuff that's critical for just the daily operation of the global financial system, it's not that everybody just gets laid off and then we have absolute chaos in the financial sector for 2 months. No, it could just say, you guys keep going to work or wherever. It's just, you are now a regular bank. You don't have any special legal privileges that other banks do not have. All right. And so probably the New York Fed's dominance in that area will erode over time once competitors can come in and do things and so on that right now they're legally barred from doing because, that's the prerogative of the Fed. All right. And one thing in particular that the Federal Reserve banks will not be able to do after this reform that we're talking about in this episode is that if the New York Fed, and maybe they would rename it something to avoid confusion, but if that bank goes out and tries to buy assets, then the very act of it doing that will not create legal tender base money. Right. Whereas right now, when the Fed goes and buys $1 billion of mortgage-backed securities and electronically transfers $1 billion into the accounts of the sellers of those mortgage-backed securities, it's not like that $1 billion has to, quote, come from somewhere. No, the Fed just creates it. The very act of the Fed purchasing assets creates the reserve balances. And since the U.S. dollar is no longer tied to gold, then there's nothing stopping the Fed from doing that. All right. It's true. Citibank, if they grant somebody a mortgage, there is a sense in which they also create money out of thin air too. It's not that money came from somewhere necessarily, but there are stricter limits on Citibank, like we've talked about. Right. If everybody showed up and wanted their money in terms of cash, Citibank would be in trouble. Whereas if everybody, all the commercial banks that think they have a certain amount of reserve balances with the Fed, if they all showed up next Thursday and wanted their money, meaning they wanted cash, the Fed could just have that printed up. Right? So that's showing the distinction that when the government designates a particular bank as the central bank, it gets certain privileges. Like it's good to be the central bank, right? If you don't have a moral system. Okay? So that's what I'm talking about here is it's not necessarily that all the Federal Reserve banks need to shut down. It's just that they're going to lose all their special privileges. And that privilege of being able to be the issuer of official U.S. money reverts to the Treasury. Okay. Now, what policy then should guide Treasury officials? So here, technically, I could have just stopped there. But to give people some more, if they say, okay, well, what reason do we have to suppose that your proposal is going to be any better than what the Fed's doing now? I'll give two responses. Number one is I'm going to give you some more specifics in a second, so hang on. But number two, even if I didn't, I would argue that would still probably make sense to take away this privilege from the Fed and give it back to the Treasury because there is something perverse and corrupt about the way the Fed works right now. That it is a quasi-private / public organization or entity that is literally owned by private banks. All right, so the analogy I used in the zero hedge debate, I said that would be like if the pharmaceutical companies literally own shares of stock in the FDA, right? So it's well known that there's what's called the revolving door, and that people who are working for the FDA, once they retire, they might go and have really nice consulting contracts, being a spokesperson for or a consultant to the big pharmaceutical companies, right? So they can't literally just say, hey, FDA commissioner, if you approve this product, we'll give you $100 million in your Swiss bank account. Like they're not supposed to do that. But they've come up with clever ways to reward people who play ball once they're out of office and things that's not technically illegal. All right. So I'm not saying, of course, that the FDA doesn't have any cozy relationship with the pharmaceutical companies right now, but I'm saying at least on paper, it's not that the pharmaceutical companies literally own the FDA, whereas on paper, it is the case that private banks literally own the Federal Reserve. Okay, they own shares of stock in it. They get paid dividends out of the Fed's profits, right? So I'm saying that's an odd arrangement. And then the element I brought up in the debate was, or the example I brought up in the debate, the Fed is technically supposed to be somewhat independent of the federal government, right? So ultimately, all of its power comes from the authorizing legislation that originally comes from Congress. But, with the original Federal Reserve Act, and then it was amended in the 70s. There was a big reorganization in 1935, and then in the 70s, again, once, they left the gold standard, that's when the so-called dual mandate came into play and so forth. But the point is, like with the recent feuding between Trump and Powell, the idea is that, the Fed is supposed to be independent. We want them just setting policy in the interest of macroeconomic stability based on the wonky models that the economists come up with, not the vagaries of political demands and so forth, right? So that's the story, and that's why the financial press loses its mind anytime a president offers an opinion of what the Fed should do with interest rates. But I'm saying that's perverse in this context because the Fed is able to do things because it gets special privileges from the government. And so, for example, the example I used in the debate was after the financial crisis hit in the fall of 2008, the Fed started engaging in what was called extraordinary measures, and they set up various facilities like lending windows and credit facilities where institutions could pledge certain types of assets as collateral that they would not be able to borrow against in the conventional market, or at least they would have a huge penalty applied. And the Fed was valuing their assets more at par, which did not make economic sense at the time, right? So-called toxic assets and things like that. Okay. And the Fed had been advancing many, I think hundreds of billions of dollars, like they were rolling over, just in a few months after the financial crisis hit. And so in December of 2008, Congress calls Bernanke, who was the chair at the time, before it, some relevant subcommittee or something, to just give them an update, like, what have you been doing since this financial crisis hit? And he goes through and says all this stuff. And then somebody asked him the question, I'm paraphrasing, of course, but the spirit of it was, Chairman Bernanke, we here defer to your expertise. We're not second guessing these many billions of dollars that you say you've been lending to various financial institutions since September. But, just in the interest of the public knowledge and so forth and disclosure, can you give us a list of those institutions just so we know who are you giving these billions of dollars of loans to? And Bernanke said, congressman or whatever, I don't know if it was a senator or a congressman, I can't tell you that. I can't disclose that information because the very nature of these programs are for financial institutions that are in financial difficulty. And so them coming to us and posting their collateral in order for us to give them liquidity, if the public knew who was taking advantage of this facility, then they would short that bank, right? And it would defeat the whole purpose of the program. This is supposed to restore confidence in the financial system. If instead we just mentioned, which institutions were taking advantage of these programs, that would just put a bullseye on them, and that would just further intensify the panic. And so no, I'm not going to tell you. So my point is, isn't that amazing that Bernanke and the other members of the FOMC, Federal Open Market Committee, are making decisions that involve the billions and billions of dollars flowing out to various institutions, some of which later we found out were foreign banks. They weren't even U.S. banks because they were holding mortgage-backed securities and other sorts of collateralized debt obligations and things that were imploding when the housing market collapsed and all that stuff, all the dominoes started falling. There were institutions that were in serious trouble and they would have gone down, and the Fed rode in for the rescue. And again, some of those institutions were foreign banks. Okay, so Bernanke is creating all this money, rescuing all these institutions, and won't even tell Congress who they are. And they were just like, oh, okay. So I'm just saying there's something perverse about that. That the way I put it in the debate was, my first best scenario is the federal government doesn't give any privileges to any institution, stays out of money and banking altogether. The next best, I would say, is yes, if you're going to have a government that reserves for itself the right to issue the legal tender money, the base money, then that should be a very transparent process where the public knows exactly what's going on, who's making the decisions, so that to help avoid corruption, but also when things go wrong, like if there's too much inflation, they know exactly who's responsible and they can vote those people out. Whereas what we have is this weird hybrid that's the worst of both worlds, where there really isn't much accountability. The public doesn't know exactly what the Fed is doing, but the Fed does have this legal privilege to issue legal tender money at will. But, if inflation's too high or something, it's not that. I mean, the Fed the board members, board of governors, the Fed, they have 14-year terms, appointments, right? The whole idea is, this is going to give them a longer time horizon. They're not going to be subject to the vagaries of the political cycle and whatever. But the flip side of that is, even if the public is very much against what they're doing, they can't directly do anything to them, right? The most they can do is, when those people's terms expire, have voted for somebody who says, and when I'm in office, what I'm going to do when I appoint someone to be like the Fed chair or whatever, like this is what, this is the kind of person I'm going to pick, a hawk on inflation or whatever. Okay. So that's what I'm getting at. So here, I think there is an argument to be said that for putting that power back in the hands of the Treasury, even just in terms of public scrutiny and accountability, and just, hey, if you're ostensibly going to be saying for the common weal, that's why we're doing this. We're giving this power to the government because we don't trust the wildcat banks in the private sector, blah, blah, blah. Okay, well, then the public should have some oversight, right? What makes no sense is to say we can't trust those corrupt, money-grubbing private sector bankers, right? Like, it was such an outrage in 1907 when people had to go hat in hand to J.P. Morgan, right? That's the lore behind why the Fed was created, was the panic of 1907 showed the weaknesses of the U.S. financial system and the power of individual people like J.P. Morgan. And so they say, we got to have a public institution that's going to act as a lender of last resort and issue an elastic currency and keep it in the hands of the people. Well, no, it's not in the hands of the people right now. It's the bankers just have this nice little gig on the side. All right. So they're still running the show. It's just now they have this engine of inflation in their toolkit. Whereas if everything were just purely private sector, they couldn't compel someone to hold their banknotes. Okay. So to round out things, you say, all right, Bob, what policy do you propose that the Treasury would follow? And I say, go back to the classical gold standard. The people are vaguely familiar with how that worked. Lots of people around the globe still think of gold as the true money. So let's go ahead and run with that. And here, I'll link in the show notes page, but Ludwig von Mises had a proposal for how to have a major government go back to the classical gold standard, and he solved two problems that I had. So number one is, if you say, let's go back to gold, the question is, well, at what price? Right? Like, it's historically, it was right before World War I, it was about $20.67 for an ounce of gold. That was kind of the ratio. It was defined in terms of grains of gold, but it worked out to about $20.67. Then FDR devalued the dollar and made the dollar price of gold $35 an ounce. All right, and then that bounced around, and then right now on its books, it's at, I forget the exact number, it was $40 and something, or in the 40s, I mean. Okay, but the market price of gold right now, I just checked, it's trading at like $3,300. All right, so if you were to try to go back to those historical prices, it would involve a massive amount of monetary deflation, right? That the authorities would have to suck out a lot of the money stock right now if you wanted to get it that the U.S. government, in terms of the gold reserves it held, backed up the dollar, 100%, if that's what the goal was. All right. So you say, oh, geez, that would be pretty painful. That would cause a massive dislocation to like have to absorb and destroy whatever 90% of the existing monetary stock. All right. The problem though then is you say, okay, so those historical anchor points are no longer relevant. What should we use? Well, if you just make up a number, that's also kind of arbitrary, right? And then the other problem is whatever number you do pick, right now, the authorities do not have that much gold sitting in the vault backing up that amount of dollars. And so what are you're just going to say, oh, let's have a 12% ratio? Like that doesn't make sense either, right? Like that's arbitrary. So in terms of someone who likes market outcomes and to defer to market forces and have things be automatic, as it were, if you start saying, how could you tie the US dollar back to gold? You start running into all these issues. And so Mises had this great proposal that just elegantly sidestepped these issues. What I'm saying right here, I think, is a little different because I think Mises' proposal, he even wanted the commercial banks to have to fall under this system so that even like M1 would be subject to what I'm about to describe. So to be clear, for various reasons, partly because I don't want the government, I want them to back off the banks, the private commercial banks more and just try to let market competition discipline them, right? In other words, I think even if you really like 100% reserves, even for commercial banks, for me, strategically, don't have Washington, D.C. try to enforce that because actually they won't. They'll relax it in a time of war or something. So I think actually the better approach is to just withdraw FDIC, the central bank, acting as lender of last resort and whatever, and just try to let the commercial bankers know if you get caught and there's a run on you, you're going down. And then in the public, you should know that. And so when you're picking where to put your checking account, maybe look at what their investment policies are and don't just pick the bank that's closest to you or, oh yeah, their ATMs are under the roofing, so I don't get rained on. Whereas this other bank, pick it on more sound fundamentals, not the things that people care about right now, thinking, oh, well, there's FDIC. What do I care what my bank does with the money? Okay. So, going along with Mises' proposal, insofar as we're talking about the monetary base, what that would look like is something like this. The authorities announce, hey, we're phasing out the Fed. We're transferring all of the Fed's existing assets and liabilities to the Treasury. The existing Federal Reserve banks can continue operation, but they're just regular banks now going forward. And we're going to have the following policy that starting, 3 months from now, going forward, we're going to have an official US dollar price of gold. And anybody on planet Earth who gives to us either currency, physical green pieces of paper, or reserve balances with the Treasury that are electronic right now when we first transfer them over from the Fed, we will give you that amount of physical gold less a small service fee if you surrender those dollars to us. Going the other way, anybody who gives us that physical amount of gold, we will create new amounts of either the paper currency or reserve balances with the Treasury for this special account. Okay, and something I forgot to mention, all existing Federal Reserve notes from the moment of the reform continue to have legal tender status, but if anybody ever wants to replace them, they can, and we'll just issue U.S. notes in exchange, and they'll look similar and official so that people will realize this is real money now. Okay, so the idea is over time, the stockpile of Federal Reserve notes will probably shrink, but like if you find Uncle Frank had $6,000 in Benjamin Franklin's in his attic somewhere because he was paranoid, it's not that you missed out. Like if you find that, no, that's still going to be good, but over time, the amount held in circulation or held by the public will presumably dwindle. Okay. And there'll be no newly issued Federal Reserve notes going forward because the Fed doesn't exist as that sort of entity anymore. Okay. And when you say, okay, but what's the price? You just said, yeah, the dollar gold ratio, it can go either way. And that's all the authorities are going to do is just maintain that convertibility either way the public wants to go. It'll be something like, we'll make that announcement and then we'll say 2 months, so again, we're saying that this redemption policy begins 3 months from now. And what we're going to do is the average price in the middle month is what we'll lock in as the official ratio. Okay. And so the idea is, and this is what I was getting from me. So the months, the timing I'm making up here, obviously, just to give you the spirit of it. But that was Mises' one of his points, right? Was to say, you got to make the announcement first, let everybody know what the new system is going to be, because that might affect the demand for gold and the new currency that's going to be locked in like this. So you got to give markets time to figure that stuff out and to have officials, answer questions and have people realize, like, wait, how's this going to work? And then once things settle down, then that's the price you just lock in, right? So it is a market. You're just locking in the market price once you let everyone understand what the new system is going to be, right? So it doesn't involve massive deflation. But then you say, okay, but how do we get, more and more backing? Because going forward, the only way that new U.S. notes get issued, it's not, the authorities don't say, well, let's see if the population's growing, or we should probably have the note issue at a 2% baseline growth. They don't have to do any of that. No, there's no discretion. It's just whenever somebody wants more, if somebody does want more paper notes, U.S. legal tender notes, 100 U.S. dollars, maybe they would still have Benjamin Franklin on it. It's just instead of saying Federal Reserve note, it would say official U.S. note or something like that. If somebody wanted that, then, and when I say somebody, I don't mean Joe Schmo. I mean, it could be like a bank that wants to replenish its ATMs and things like that. They could just go and they would have to go get a bunch of gold and go turn it in at the official. So maybe, the official price ends up being gold is $3,000 an ounce. And so they would just go and get 10 ounces of gold and turn it in, and then they would get $30,000 worth of freshly printed U.S. notes, this legal tender, right? And then they could go put those in the ATMs and whatnot. Okay, so going forward, if you think about it, as the supply of U.S. notes grows, because over time with population growth and things like that, different regions of the world adopting the U.S. dollar as their currency or whatever, because their own currencies are failing, the total number of U.S. dollars held in cash balances presumably grows over time. Okay, and so the point is that new increment is all backed 100% by gold. And so over time, when you say what is the backing of the entire stockpile of official U.S. dollars, that ratio grows over time. Okay, so it's you're trending towards 100% gold backing of official U.S. dollars, but it's not right out of the gate that would require a huge deflation. Okay, so one last thing here is that I realize this also solved a problem that I wasn't sure about in terms of, remember earlier I showed you the Fed right now is sitting on trillions of dollars of treasuries and mortgage-backed securities in terms of their assets on their balance sheet. And Powell has been allowing that to roll off gently over time, right? The Fed's total assets have been shrinking steadily for a while now. And so then the question is, well, what do you do with it? Like, should they just, as treasuries mature and the Fed now gets those dollars returned to it, what should they do? So what they have been doing is rolling it over and buying treasuries, and but on net, just letting some of them, shrink away, and so they're effectively sucking dollars out of the system. Okay, but what you could do here is just say, no, we're letting that mature, roll off the balance sheet naturally, And it's not that we have to come up with, well, gee, should we maybe for every $1 million that evaporates, should we let 500,000 completely disappear from the financial system, but then go buy $500,000 worth of gold at that, price we said? Again, the issue is, well, that just seems arbitrary. I don't know. Like you would think that, we want to switch away from the Treasury initially owning all those mortgage-backed securities and all those Treasury securities and switch over to they're just owning stockpiles of gold backing up their liabilities, which are the U.S. notes. But what's the management policy? And so I'm saying this proposal elegantly solves that. It takes the guesswork out of it, right? The Treasury inherits this stuff, and then as it's maturing, effectively, like they're getting incoming dollar payments, right? So you think about like a mortgage-backed security, other people in the private sector are paying their mortgages, and then the money's getting rediverted, and ultimately money payments are being made to the Treasury insofar as it has inherited the assets from the Fed, right? So just think of it as a bunch of Federal Reserve notes coming in, and so they can let those mortgage-backed securities expire, roll off their balance sheet, and they can just burn the Federal Reserve notes, right? Because that's kind of what they want to do anyway, is get rid of those things. And then you say, oh, but wouldn't that be deflationary? Okay. And so if originally, again, the gold price in the new equilibrium was $3,000 an ounce, and by the way, you might say, well, wouldn't it be way higher? And I think there's two main effects going on. On the one hand, people thinking, oh, the U.S. government's going to start buying gold now. That's going to make gold prices rise. Right now, there's this huge new buyer of gold in the world. So yes, that would make gold prices rise. But on the other hand, the new policy would make everybody think, oh, the dollar is going to be a lot stronger now than we would have forecast 2 weeks ago before we knew about this policy shift. Okay, so the strong dollar would make gold prices measured in dollars fall. And so it's not obvious which way. So I think definitely gold prices quoted in euros or yen would go way up, but the dollar would strengthen against the euro and yen also. So it's not clear what the dollar price of gold would do. And that's partly the reason for delaying locking in the price, is you give markets time to sort this stuff out. Okay, but again, suppose it's $3,000 an ounce. That's the official price that they lock in, saying from now on, the U.S. dollar, one ounce of gold is interchangeable for 3,000 U.S. dollars. Either way. Okay, so the mortgage-backed securities are maturing. They're rolling off the Treasury's balance sheet. Federal Reserve notes are flowing in, and they're just burning them, or electronically they're coming in, and then they're just reducing the electronic liabilities that they inherited from the Fed, that those are shrinking. Okay, so in a sense, the base money is shrinking, and then what would that tend to do? That would tend to reduce dollar prices of everything, including gold. And so that means if the market price of gold, in terms of just, people buying gold out there in the wild, if that drops to 2,900, well, now there's an arbitrage opportunity, right? You can take $2,900 of Federal Reserve notes, go buy an ounce of gold in the marketplace, go deposit that ounce of gold with the authorities, and then they will create $3,000 worth of U.S. notes and give it to you, right? Because that's the rule. It says anybody wants new legal tender U.S. notes, you give us a certain weight of gold, and then we will print up, or we'll have an electronic credit to you if it's a big number and you just want to have it at your bank electronically, that much in official U.S. money, base money, right? And so you see how it would naturally do what we said, that is the mortgage-backed securities are rolling off and maturing, that would tend to suck dollars out of the system. The price of gold would tend to fall, and then there'd be an arbitrage opportunity. So people would buy up gold at the below target price, hand it over for an arbitrage opportunity to the authorities, and they would print up the money. And so we can see over time, is the Treasury's balance sheet for this component that's in terms of monetary policy, is those assets are maturing and rolling off, they would be replaced by gold. But again, it would be based on the public's demand, right? It wouldn't be that the authorities would have to exercise discretion and do some sort of official conversion program. No, they would just say, we're sitting here as these assets roll off, money's getting sucked out of the system. And then if anybody wants to give us gold, we'll print up new dollars. But, and partly the reason I'm saying this is because the Fed's balance sheet exploded first after the financial crisis and then especially after COVID. And so there's a sense in which a lot of people think right now the Fed's balance sheet is bloated and that it does need to shrink even to be consistent with normal prices. In other words, people think the Fed's balance sheet could fall 20% and we could still have like 2% consumer price inflation going forward, right? Because it's more that the Fed's balance sheet exploded and we didn't see eggs go up to $30 a carton. And so, we got to suck some of that out to reassure everybody that that was just a one-time injection or a four-time injection, not a permanent change in monetary policy, okay? So I'm saying this proposal that I'm adapting from Mises allows all that to happen. That, if it is the case that the Treasury's assets should shrink down and the amount of base money should get sucked out of the system to be consistent with keeping gold at $3,000 an ounce, then that will automatically happen. All right. And then one last thing, and I'll wrap it up. On the flip side, how does it work? That suppose for whatever reason the public gets fearful, they start doubting, like maybe a war is looming, right? Imagine that, how implausible scenario. People are worried the U.S. government's going to get involved in a major war, and so they start doubting that the Treasury is actually going to stick to the pledge, and so maybe the market price of gold starts trending up. It starts getting bid up because people start thinking that, no, I bet you they're going to break. And even though right now they're locking in saying the dollar price of gold is $3,000 an ounce, as far as the eye can see, we bet you that's not going to happen. Once they're fully at war with China, gold's going to jump up to $3,500. So we're going to buy. And so maybe the market price of gold gets bid up to $3,100. So what are the arbitrage mechanisms that kick in place is you can take your gold, anybody in the private sector, anybody who has $3,000 of U.S. notes hands that to the U.S. authorities and says, give me an ounce of gold. And they do. And then you go and you sell that ounce of gold for $3,100, which we said that was the market price in this thought experiment, right? So you just arbitrage and gain the $100 spread, right? You took your original $3,000 and turned it into $3,100. All right, and then think about what that does, though, is you took your $3,000, handed it over to the authorities, and they gave you an ounce of gold. So what do they do with those 3,000 U.S. notes, $3,000 worth of U.S. notes? They burn them. Okay, so $3,000 worth of official U.S. base money was destroyed in that scenario. And so the more people that do that, then that reduces the inflationary pressure. And so the $3,100 market price of gold falls back down. So even if people were building in expectations that, they might break, and so they start bidding up the price of gold, if the market price goes above that $3,000 benchmark, arbitrage opportunities kick in that tend to suck dollars out of the system. And so that's how, this proposal keeps the market price of gold centered on the anchor point of $3,000 an ounce in this example. Again, just to be clear, the $3,000, the authorities are not picking that. They're just locking it. I'm using that just for convenience, for arithmetic purposes, but the actual number might be, 3184 or something, right? Again, they would just figure out what's the market price once we think everybody's adjusted to this announcement that this is the new policy, and then we lock that in. Okay. So I think I've given you more than enough there to chew on. I will link to, I wrote up the specifics of Mises' proposal for how to get the U.S. dollar back on gold. And again, the point of this is more just to show this could be done. There's a way you could get rid of the Federal Reserve, at least as its in its capacity as a central bank enjoying certain legal privileges, and still have official U.S. dollars without being too disruptive. And so you could, by doing this approach, I think you would have a much firmer foundation for money and banking, not just for Americans, but the rest of the world. Okay, thanks for tuning in, everybody. See you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.